Hello, my name is Clive Corcoran, and in this screencast or video tutorial I want to look at two rather key ideas in the world of finance. I want to look at the degree of correlation or co-movement between different securities, different assets, and then I want to tie this into a discussion of a cornerstone idea in finance known as the efficient frontier. This screencast is part of a series of such tutorials and videos that I am creating for my YouTube channel, the Corcoran Codex, where I will be putting various critical ideas in the world of finance under the microscope and analyzing their significance and implications. Now, let us begin by talking about portfolio risk. In other words, we are combining different securities, different assets, either from the same asset class or from different asset classes, and we're putting them into a portfolio. And we want to understand the dynamics of that portfolio. We want to understand its risk characteristics and so on. Now, cross-asset correlation, what I mean by that is the degree to which, say, the securities that are going to be included, the degree to which their price behavior is similar or dissimilar, sometimes known as the degree of co-movement between these different securities. When we look at the correlation structure, for example, of the different securities, it gives us an insight into the risk characteristics of that portfolio. Measuring correlation in price behavior essentially involves calculating a statistical measure or metric known as the correlation coefficient. The values for this metric lie in the interval between -1 and +1, and they can be calculated easily, for example, in Excel. If two securities uniformly move in the same direction, they are said to be perfectly positively correlated with a coefficient of 1. If, on the other hand, the securities always uniformly move in the opposite direction to one another, they are said to be perfectly negatively correlated, and that metric, from the correlation coefficient point of view, has a value of -1. Those, of course, are the limits, and when we look at the actual behavior, say, between two securities and measure it, we'll find some value that's in that interval between -1 and +1. Let me try to give an intuition now as to the impact of correlation on the overall risk of the portfolio. Now, obviously, in most portfolios, we'll have a number of different securities, a number of different assets and so on. But just to begin the discussion, let's consider that we're just combining two assets, A and B, maybe two equities. Now, as you can see, we have a pathway here that is being followed over time by security A, and likewise another pathway also for security B. Now, it turns out that these two pathways, if you wish, once we've measured their correlation, we find that they are perfectly positively correlated. They always move in the same direction, uniformly. Now, if we were to combine A and B in a portfolio, then because their behavior is identical, they basically move exactly in line with each other, then we would have no reduction in the risk. We'd have no diversification benefit as a result of combining A and B in the portfolio. If, on the other hand, we see that A here moves along this pathway, B moves along this pathway, and we measure the correlation, we find that in this case, when A is moving up, B is always moving down, and vice versa. They would have a perfect negative correlation of -1 in this case. And if we were to combine A and B in a portfolio, what we would do essentially is eliminate all risk. Because if this is going up and this is going down, doesn't matter what the overall market's doing, one is neutralizing the other. So we would reduce or remove actually all of the risk, but also we of course would remove any potential for a gain in the portfolio. Much more likely when we examine the degree of correlation between A and B, and we measure that with the correlation coefficient, we would find some value, let's say 0.345, it could even be negative. Now, if we do combine A and B in the portfolio at that point, we would actually see some diversification benefits, and we could thereby actually reduce quite significantly, perhaps, the degree of risk in the portfolio based on the combination, in this case, of A and B. Now, once we've established the idea that relatively weak correlation between, say, A and B leads to a diversification benefit, we're now beginning to echo something that has been around in the world of finance theory for decades. It's called modern portfolio theory, but in fact it's actually not modern at all. It stems back to the 1950s, and the academic who developed this idea, Harry Markowitz, recently deceased actually, won a Nobel Prize for his contribution to this area of finance, modern portfolio theory. The theory basically states that when you do combine securities in a portfolio, you will receive diversification benefit, especially if the degree of correlation in price movement is relatively weak. Now, the problem, though, with MPT, modern portfolio theory, is that when you would most want to benefit from diversification, in other words, have a reduction in risk, that is exactly the time when you're almost inevitably not going to find a benefit, because, let me give the example on the screen. This goes back to the October 2008 timeframe. What I did was take 5 ETFs, you can see them listed here, the S&P 500, the UK index, German index, and so on. And what I can show quite clearly here is that in the fourth quarter of 2008, whereas there had been different pathways and different trajectories taken by these ETFs, during this time frame, they were all essentially moving in tandem. They were perfectly positively correlated, and maybe somewhat counterintuitively, when you use the term perfectly positively correlated, you tend to maybe think they are starting to move up together. Well, in this case, of course, they were moving down together. They were basically crashing together. Now, the same thing basically can also be seen here in March of 2020. This, of course, is the period when we were beginning to see the full impact of the COVID pandemic. And I've used not exactly the same set of ETFs, but very similar ones. And you can see once again different pathways taken before the beginning of 2020, and obviously very different pathways subsequent to that. But during the critical period here, in March, April of 2020, once again, there is almost 100% positive correlation, because they're all again basically dropping precipitously at the same time. Let us supposing we're going to combine just 2 assets in a portfolio, and we want to, for example, to calculate the risk, the standard deviation, essentially, or variance from which we can get the standard deviation. It turns out that the formula or equation where you are combining A and B in a portfolio corresponds to the equation on the screen. So, for example, PA here is the percentage of the portfolio which we will allocate to security A. And sigma A is the standard deviation of the returns of security A. Likewise for B, we have some further terms in the equation here. And the final term in the equation is this one here, the coefficient of correlation between A and B, and what we're now discovering, or what we're now calculating, is the degree of co-movement over time in the price behavior of A and B. Now, once we have taken on all these various ideas regarding correlation and combining assets in a portfolio, we now are in a position to examine quite an important idea in finance theory, known as the efficient frontier. So as you can see, I've use the formula, the one we just looked at on the last slide, and you can see what I've done is take two assets, maybe two equities, whatever, A and B, and in this case we know, based on previous history, that asset A has an expected or average return, maybe over the last 2-3 years, of 16% with a standard deviation of 15%. Asset B has an expected return of 24% with a higher standard deviation of 18%. Because we have thereby all of the values that we need to plug into this equation, we can go on and calculate the variance of the portfolio and the standard deviation being the square root of that. The idea with the efficient front here is that we can use a sliding scale here to alter the allocation, in other words, the percentage or proportion of our capital allocated to A and thereby B. If everything is allocated to A, then obviously the portfolio is only A, 16 and 15%. But what we can do now is to reduce the allocation to A to 90%, 80%, and all the way here down to 0%. So if we're down at 0%, it means that nothing is allocated now to A, everything is in B, and that likewise we can see that we get B, 24% and 18%. The intermediate values, of course, are the very interesting ones. So we've used the formula, we plugged in the right parameters, and we can see now that we end up with the standard deviation in this column. Expected return is relatively easy to calculate. That can be found in this column. And what we can then do is we can create a plot here in which we take the horizontal axis based on this column and the vertical axis based on this column. We join up the points and we find this shape here, this curvature idea. Now, the important point with the efficient front here is that a rational investor would not want to invest essentially below that point on the curve, because to take that point there, which is actually highlighted in yellow, we will receive a return somewhere around 22% with a 15% standard deviation or risk. Now, that obviously is far preferable to being here, where we are also incurring a 15% risk based on the standard deviation. And in fact, that is, of course, this row here. So the rational investor will want to be at least there and might want to go further out on this part of the curve. Now, the final idea to tie all this together is we can also calculate what is known as the Sharpe ratio. The Sharpe ratio, as it says over here, is the expected return, this column, minus the risk-free rate, which in this case I plugged in at, say, 4%. That could be a policy rate. It could be, say, the yield on a 3-month T-bill, whatever. And we divide that numerator value by the standard deviation in this column. And we can see the results in this column here. And we can find that actually 1.17 or 1.17 maximizes the Sharpe ratio. That might well then be the basis for making the decision as to what allocation you wish between A and B, based on the sliding scale idea that I explained. So I hope you enjoyed that discussion. I hope you found that useful. And could I suggest that you subscribe to my YouTube channel, the Corcoran Codex. Thank you and goodbye.